Hey YouTube, this is Mr. Retired by 50 here with the next video for you. This one is all about comparing and contrasting high dividend growth strategy versus the high dividend yield strategy. So this is a follow-up to the last video I made, which was about Johnson & Johnson and how you can turn $1,000 into $1 million by just reinvesting those dividends. And now I'll also compare that with the high dividend yield model, which you can see with companies like AT&T and Verizon. I chose AT&T because I used to be an AT&T customer, so that one was the first one to pop into my mind, but you can also see this with utility companies, etc. So those two I'll kind of compare and contrast so we can see how those different strategies work for different people. I also just want to answer one common question that got brought up last video, and that was, is that $1,000 that you turned into $1 million, is that just a one-time investment, or is that a weekly investment, yearly investment? How often did you invest that $1,000 to create that $1 million? And to answer that, it was just a one and done thing. As long as you reinvest those dividends back into your initial principal, which every brokerage does this nowadays to include Robinhood, they will take that dividend that you get, whether it's $25, $100, $1,000, and just roll that back into your initial principal. And that is the foundation of how you continuously, passively grow your wealth. So with that, I'll take you to the Excel spreadsheet and we'll walk step by step of how to compare and contrast the two strategies of dividend growth stocks and dividend yield stocks.
Hey YouTube, here's that Excel spreadsheet that I was talking about and the comparison between Johnson & Johnson and AT&T. First, I'll walk you through some of the numbers in the background so you know I'm not making all this up. Starting with Johnson & Johnson here, as we all are familiar with from that last video, I won't spend too much time with this. Nice stock growth in the past couple of months. If you're an investor like myself, pretty happy with it. Dividend yield 2.6% in the Excel spreadsheet. I ran it for 2.5%. And then kind of like I rolled through in that last video, you can see a solid average of approximately 6% over the past couple of years for the dividend increases. AT&T, on the other hand, here we go. Here it is. Once again, awesome stock growth over the past couple months. If you're an AT&T investor, you're pretty happy with this. But looking at some of the numbers, 5.3% yield, and this will, of course, fluctuate depending on stock price. I ran it for 5%, so a little bit less. And then the dividend growth for AT&T has been very consistent of approximately 2% over the past couple years. So those are the numbers that I ran with. So I'll take you to that Excel spreadsheet once again here, and I'll kind of roll you through the numbers real quick so we can get to the comparisons throughout the different years. So year one, we're just investing $1,000 into Johnson & Johnson or AT&T, and we're not putting any other money back into it. It's just going to be automatically reinvested through whichever brokerage you have. Dividend yield 2.5%, growth 6%, just talked about that. And that would give you an awesome paycheck of $25 in that very first year to hold Johnson & Johnson, which will increase every year. AT&T, on the other hand, $1,000 initial investment, 5% yield, 2% annual growth. That'll give you $50 that very first year. So twice as much, 2x from Johnson & Johnson that you would walk away with in year one. So we'll fast forward to year 10 and see how this looks. This over here would be what your portfolio looks like. Here's a little chart if you're a visual person like myself, and you see that AT&T would be 85% greater than Johnson & Johnson for your initial investment, which AT&T for the win for that initial 10 years. For the dividend payout, it looks very similar. AT&T would give you 74% more than Johnson & Johnson in that first 10 years. It's not a whole lot of money, but hey, you'd be getting $96 annually. Fast forward 20 years in the future, and your portfolio is a bit larger. Once again, AT&T is still on the top there with a 2251. 2,251. Don't know why I said that so weird. And that's a 50% increase over what Johnson & Johnson would be giving you. Passive income wise, for those dividends that they'd be paying you just to hold on to the stock, once again, AT&T for the win, 28% higher than Johnson & Johnson. But Year 30 is where I kind of want to focus a little bit more. That's where things start turning around. For the investment size, your portfolio, it would look very similar. Actually, AT&T 7% more, but Johnson & Johnson starts catching up very quickly. And on the dividend payout side, you'd be getting more dividends from Johnson & Johnson. Things start turning around year 25, as you can see with this crossover point. Johnson & Johnson would pay out $798 versus the $580 from AT&T. So this is important because it depends on what your goals are. If you're only holding onto a company for 20 years, let's say you bought into this company at age 60 or 50, when you're 70 to 80, if you think that's all the time you need for these dividends to come at you and you can use them for paying bills or paying off other expenses, this might be the ideal stock for you, these higher yielding stocks that don't grow too much. Whereas Johnson & Johnson, if you have more time, let's say, here's year 40, if you started investing when you were 20 or 30, 40 years down the road, you're 60 years old. This is an awesome time to start looking at your investments. Your $1,000 just turned into $36,000, which is a 52% increase than what AT&T would be giving you. And on the passive income side of the house, you'd be getting $7,000, over $7,000 annually versus $1,700 annually from just holding on to the stock. This is how much money they'll be paying you. And you can see a graphical depiction here. And that's pretty impressive, exponential growth if you have the time for it. And just one more decade, 50 years, actually 51, because I just wanted to show you that $1 million mark. Your initial investment would turn into $1 million. And that's just putting $1,000 down. So if you were 20 years old, you put $1,000 into a stock, 50 years, 51 years down the road, it turns into $1 million. That's either great for yourself, or if you're going to hand it off to the kiddos, that's a huge lump sum of money that you could hand off to the kiddos. That's 93% for Johnson & Johnson over what AT&T would be giving you. And then on the passive income side of the house, just check out this chart here. That's amazing. Johnson & Johnson would be paying you $318,000 annually to live off of. That is awesome. That's 97% more than AT&T. And once again, this all depends on your life goals, how much time you have to do it, and how much money you can put into these investments. I started when I was, in college, making mistakes with penny stocks, and then I moved on to these dividend stocks. And I wasn't putting $1,000 down. I was putting closer to about $200 down at a time, paying the $10 commission fee or $12 commission fee. So hopefully, 50 years down the road when I'm 70, I can have some awesome passive income like this. We'll see. Stay tuned for that. But once again, this is just a quick comparison, contrasting of the dividend growth strategy versus the dividend yield strategy. If you did like this video, don't forget to like and subscribe to my channel. Thanks a bunch. See you guys next time.